everyone, and welcome back. If you're anything like me, you're always looking for those little bits of knowledge that can give you an edge in your investing, right?
Right.
So today we're going to do a deep dive that will make you a savvier mutual fund investor.
Okay.
Specifically, we're going to demystify something called an exit load. Have you ever heard of an exit load?
Of course, it's a pretty common fee structure in many mutual funds.
It is, yeah.
Yeah.
You know, it can be a bit tricky if you don't know what it is or how it works, right?
Yeah, absolutely. And for new investors, it can come as a surprise if they're not reading the fine print.
That's why we're doing this deep dive. It's all about understanding what an exit load is, and more importantly, how you can potentially avoid it.
Exactly.
So to jumpstart this, we're going to be pulling some key insights from the Smart Seed Investments video.
Yeah.
They did a really nice job of breaking things down.
Yeah, they did.
All right. So first things first, for our listeners who are maybe new to this, what exactly is an exit load?
You can think of it like a fee for pulling out of your investment a bit too soon.
Too soon, right?
It's kind of like if you break a fixed deposit before maturity,
Yeah.
you end up paying a penalty.
Right.
It's a similar concept here with mutual funds.
Yeah, okay. So, in the simplest terms possible for our listeners out there, what are we actually talking about when we say exit load?
Well, an exit load is basically a percentage that's deducted from your investment.
Mm-hmm.
If you decide to sell your mutual fund units before a certain period has passed, the fund basically says, hey, we're in this for the long haul. We want you to be too.
Yeah, they want you to hold on.
So if you bail early, there's a little price to pay.
Oh, I see. Okay. So it's not just about the fund company making extra money. There's a strategic reason behind it.
Yeah, definitely. The Smart Seed video really highlighted that. It's all about discouraging what they call short-term trading, which can actually destabilize a fund.
Oh, interesting.
If everyone's jumping in and out quickly, it makes it harder for the fund manager to manage things effectively, right? It's like trying to drive a car where everyone's constantly slamming on the brakes and hitting the gas.
Oh, I see. So it's actually there to protect the long-term investors in the fund.
Right.
Interesting. Now, let's talk numbers. What's the kind of hit we're looking at with these exit loads? Can you give us an example?
Sure. Let's say you invest a lakh rupees in a mutual fund.
Okay, a lakh.
Which is RS 1,000, and it comes with a 1% exit load if you withdraw within a year.
1%.
Now, if for some reason you need to redeem your investment, let's say after 6 months.
6 months,
That 1% exit load means you'll be parting with Rs 1,000.
Oh, okay.
So instead of getting your full Rs 1,000 back,
You get 99,000.
exactly, you receive Rs 99,000.
So it's a real tangible amount.
Yeah. And, you know, it might not seem like a lot at first,
Right?
but it can definitely add up, especially if you're making multiple withdrawals before that exit load period is over.
Yeah, I see.
So you've really got to factor that in.
Gotcha. Now, are exit loads something we need to be worried about with all types of mutual funds, or are there some exceptions?
Yeah, great question. It's not a one-size-fits-all situation.
Right.
With equity funds, which invest primarily in stocks, you'll often find a 1% exit load
1%.
if you redeem within the first year. But debt funds, which invest in things like bonds, can vary quite a bit.
Okay, so they're different.
Some might have exit loads for, say, 3 to 6 months, while others might not have any at all.
Oh, okay. What about those ELSS funds, the ones that are popular for tax saving?
ELSS funds are interesting. They don't have an exit load,
Yeah.
but they do have a mandatory lock-in period of 3 years.
3 years.
So while you won't pay a fee for early withdrawal, you're basically committed to keeping your money in there for those 3 years.
Okay, so no exit fee, but you've got to stay in.
Right. Now, on the other hand, you've got liquid funds.
Liquid funds.
These are designed for short-term needs, and they almost always have zero exit load.
Oh, 0. Okay, so that's good to know.
So you get a lot of flexibility with those.
That's really helpful. Now, for the big question, how can our listeners potentially navigate all of this and avoid paying those exit loads? Any pro tips?
Well, I think the most straightforward way is to simply hold on to your investments for the recommended duration.
Hold on to it. Okay.
Before you invest, always check what the exit load period is,
Right.
and make sure your investment horizon aligns with that.
So plan ahead, basically.
Plan ahead.
Makes sense. What other strategies can we use?
Another good one is choosing funds that don't have an exit load at all.
Ah.
Like we talked about, liquid funds are a good example,
liquid funds.
and some debt funds might also waive those charges.
Okay. Now, the Smart Seed video also mentioned something called a systematic withdrawal plan, or SWP.
Yeah.
How can this help us avoid exit loads?
That's a great point. Let's say you've invested in a fund that doesn't have an exit load,
Okay.
and you need to access some of your money, but you don't want to withdraw everything in one go. Setting up an SWP could be a really smart move. It allows you to take out a fixed amount of money at regular intervals, like monthly or quarterly.
Oh, that's helpful.
And the best part is you won't be hit with those exit load penalties because you're withdrawing smaller amounts over time.
Gotcha. So that spreads it out. So the takeaway for our listeners seems pretty clear. Do your homework right.
Yeah, absolutely.
Know what you're getting into, understand how long you need to hold on to your investments, and consider different fund options that align with your needs and goals. That way you can potentially save yourself some money and keep more of your hard-earned cash working for you.
Exactly. And, if you connect this back to your overall investment plan,
Yeah.
it makes you really think, doesn't it, about how to split your money across different funds, considering factors like how long you want to stay invested.
Right. It adds a whole new layer of strategy.
Yeah.
I think that's a great place to wrap up this deep dive. So to our listeners, how might understanding exit loads influence the way you choose funds, and how long you plan on holding those investments? It's definitely something to ponder.
Definitely food for thought.
Thanks so much for joining us, and we'll see you in our next deep dive.
Take care.
Bye.